Welcome back to the deep dive. Today we're tackling a really critical topic if you're interested in financial markets.
Yeah, understanding and maybe even predicting stock price crashes.
Exactly. We're going to unpack this fascinating new research paper. It uses, a completely fresh machine learning approach to try and get ahead of these sudden, sharp declines. The source for this deep dive is Machine Learning Approach to Stock Price Crash Risk. It was published in the Annals of Operations Research.
That's the one. By Karasan, Alp, and Weber.
And, it uncovers some findings that were, frankly, quite unexpected.
That's right. So for this deep dive, our focus is squarely on this academic paper, but our mission really is to distill the key insights for you. We want to go beyond just, what causes these downturns and explore how we might actually anticipate them better.
Using this new data-driven perspective.
Exactly. One that adapts.
Okay, so let's start with the basics then. What exactly is a stock price crash? And why is it such a big deal? I mean, especially after things like the 2008 crisis?
Right. Well, at its core, stock price crash risk just refers to a really large negative return for a specific stock. Think of it as an outlier, something way beyond what the general market is doing. It's not just a little dip.
It's a major drop, unexpected.
Precisely. And this often ties into something called negative skewness in stock returns.
Negative skewness.
Okay. Yep. Picture it like this. Bad news tends to make a stock price fall much more dramatically than good news of, say, equal importance makes it rise. There's this asymmetry.
In how the market reacts.
Exactly, how it processes information. Now, historically, people have tried to explain this negative skewness with a few theories.
Okay.
There's the leverage effect. Price drops, debt burden feels heavier, decline gets worse.
Makes sense.
Then there's stochastic bubbles theory. Bubbles pop, big drops happen, even if it seemed unlikely during the good times.
Right, irrational expectations and then panic.
Yeah, but the one that's really relevant for today's deep dive and the one the paper connects its findings to is the discretionary disclosure theory.
Ah, discretionary disclosure. That sounds like it involves, well, human decisions.
It absolutely does. This theory basically says that companies, or rather the managers, tend to rush out good news.
To boost the stock price, yeah.
Right. But they often hold on to negative information. They stockpile it, you could say.
Stockpile bad news, why?
Well, the idea is they delay releasing it until they absolutely have to. Maybe it reaches a kind of tipping point, and when all that pent-up bad news finally hits the market all at once.
Boom, a sudden large price drop.
Exactly, a crash. And this theory is really crucial for understanding what this paper found.
Okay, so that's the theory. But how did analysts traditionally try to measure this risk? You mentioned the paper talked about things like NCSQ.
UVL. Right, yeah. Historically, analysts use these fixed kind of rule-based measures. So NCSQW, that quantifies the negative asymmetry we talked about.
Right.
DUVL looks at downside versus upside volatility. And the CR-ASH measure, that flags really big negative weekly returns, like dropping more than 3 standard deviations below the average in a week.
So specific thresholds.
Exactly. They offered a starting point, sure, but they have some pretty significant drawbacks.
And what are those drawbacks? What were these older models missing?
Well, the biggest issue is just how rigid they are. They really struggle to adapt.
To changing markets.
Yeah, financial markets are dynamic, right?
Right.
The underlying data changes. So if the market shifts or if the person using the model isn't like a deep domain expert, these models can easily get it wrong.
How so?
They can lead to false negatives, meaning they miss a crash that actually happens.
Oh, that's bad.
Or false positives signaling a crash when one doesn't occur. It's like using an old map on a river that's changed course.
That makes perfect sense. So this sets the stage perfectly for a new approach. What's the cutting-edge solution this paper proposes then?
This is where it gets really innovative. This study uses machine learning, specifically a technique called minimum covariance determinant, MCD for short.
Minimum covariance determinant, MCD. What does that do?
Think of MCD as like a really smart radar. It's designed to spot anomalies, outliers in data, even when those outliers might distort traditional methods.
So it's not thrown off by the weird data points.
Exactly. It's robust. It automatically sifts through the data, finds patterns, identifies anomalies. In this study, it specifically identifies those significant negative outliers in a stock's returns.
And calls those crash events.
Right. They actually term these NEG outlier in the paper.
And that's a big step forward, isn't it? Because it means this MCD approach doesn't need us to, guess how the market should behave beforehand.
Precisely. No prior assumptions needed.
Yeah.
It adapts.
So it gives a consistent measure, helps us understand the causes better, and you
Yeah.
said it's adaptable.
Right, adaptable to different market states. That's key.
But here's the real kicker. You mentioned it can also be used to predict future crashes.
That's the goal, yes.
Hmm.
It's a significant step beyond what those older rule-based models could reliably do.
Because they were too rigid.
Exactly. They use fixed rules, fixed thresholds, markets evolve, those rules become outdated.
So their inability to capture changing data was the big weakness.
A major weakness, yeah.
Yeah.
Which the MCD approach addresses because it learns directly from the data. It's dynamic.
Okay, now this is where I think it gets really interesting.
Hmm.
We're moving beyond just the algorithms, right? Into the psychology of the market. What about investor sentiment?
That's a great point because the study definitely brings that in. Investor sentiment is, basically the collective mood.
Optimism, pessimism.
Exactly. It reflects expectations that might not be strictly based on the available facts about cash flows or risk. It's the market's vibe.
And how did they measure that, especially for individual companies?
Well, this is another really innovative part. They didn't just use some general market sentiment index.
Okay.
They created a new firm-specific investor sentiment index.
Firm-specific, so tailored to each company.
Right. They use principal component analysis, PCA, on a bunch of carefully chosen variables. Things like PE ratio, Tobin's Q, which are fundamental, but also trading activity stuff like turnover rate, buying and selling volume, even things like leverage and closed-end fund discounts.
Wow, okay. So a broad mix to capture that company-specific mood.
Exactly. To build a comprehensive picture for each firm.
And then the paper talks about detoning this index. I like your analogy earlier, hearing the solo singer, not the whole choir.
Yeah, that's a good way to think about it.
You're removing the market noise.
Precisely. Detoning involves mathematically removing that first principal component from their sentiment index.
Because that first component usually represents the broad market effects.
Typically, yes. It captures the systematic market-wide influence. By taking that out, they could isolate the true, uncorrelated sentiment specific to the firm and see its unique impact on crash risk.
Without it being clouded by just general market ups and downs.
Exactly. It allows for a much cleaner, more precise analysis.
Okay, let's get to the aha moment then. What did this new machine learning measure, this Nugo-Liar thing, and this firm-specific sentiment index reveal when they put them together?
Right. This is the core finding, and it's quite surprising for many. They found a positive correlation between firm-specific investor sentiment and stock price crash risk.
Wait, positive. So higher optimism.
Higher levels of positive sentiment around a specific company
are linked to a higher chance of a crash.
That's what the data showed, yes.
That seems completely backward. Why would that be?
Well, it connects right back to that discretionary disclosure theory we talked about earlier.
The manager's holding back bad news.
Exactly. Think about it.
Yeah.
If investor sentiment for your company is really high, everyone's optimistic.
Yeah.
Managers might feel more pressure or perhaps temptation to withhold any negative news. They don't want to spoil the party, right?
Okay, I can see that. Keep the positive vibe going.
Right. But that bad news accumulates. Undisclosed. It reaches that tipping point.
And when it finally comes out,
because it's been held back and maybe gotten worse, the price drop is sudden and much more severe. A crash.
So the loudest cheers, in a way, could actually be a warning sign.
In this context, potentially, yes. It's a quiet alarm bell, as you put it.
And this wasn't just like a fluke. The study checked this.
Oh, yeah. They found the relationship was robust. It held up across different company sizes.
Even small versus large firms.
Yes. And importantly, it also held up when they used that detoned version of the sentiment index, the one with the market noise removed.
So it really seems to be about that specific company's sentiment bubble, almost?
It points strongly in that direction.
Sure.
And the size effect you mentioned is interesting, too.
How so?
Well, the study suggested that smaller firms, which tend to have less analyst coverage, maybe slower price adjustments, they seem more susceptible to this kind of sentiment-driven mispricing. So they're potentially more vulnerable to crashes when sentiment is high.
And larger firms.
For larger, more visible firms, where information might get priced in more efficiently, the sentiment effect seemed weaker. Though, interestingly, in some specific size categories, when they looked at the detoned sentiment, the relationship actually flipped it. Higher sentiment sometimes meant lower crash risk. So it's complex.
Nuanced. Depends on the firm.
It really does. But the overall finding about positive sentiment increasing risk was the dominant one.
So what does this all mean for you, the listener? It suggests that, well, you need to pay attention to the mood around a specific company.
Right, not just the overall market.
If you hear a lot of hype, especially around smaller companies, this research suggests maybe dig a bit deeper.
It could be a signal to look for potential hidden risks, yeah. Don't just take the optimism at face value.
Okay, so sentiment was the big surprise. But what other factors did the study find were important predictors of crash risk?
Well, some were kind of expected. The traditional NCSKW measure, that negative skewness, that was positively correlated, as you'd imagine. More skewness, more risk.
Okay. What about company size itself?
Size generally was positive and significant too, suggesting larger companies might actually have a higher likelihood of negative skewness.
Interesting. And past performance.
High past returns, RET, were also found to predict more negative skewness later on, like what goes up.
Might come down hard. Okay.
Volatility, measured by sigma, was generally significant. High volatility often linked to higher crash likelihood, though results varied a bit.
And profitability, did that help? Like ROA?
Yeah, return on assets, ROA. Here, the new MCD model actually confirmed what theory suggests, a negative relationship.
Meaning higher profits, less crash risk.
Exactly. Profitability seems to act as a stabilizer, which makes sense.
Did the old models agree on that?
Actually, no, that was a point of difference. Some traditional models showed varied or even positive relationships between ROA and crash risk, which is counterintuitive.
So the MCD model aligned better with financial theory there.
It did, and perhaps the most impactful variable, according to the machine learning feature analysis,
Yeah. What was number one?
was DTRN, the detrended turnover ratio.
Trading activity, liquidity.
That measure proved highly significant in predicting crash risk across the board.
What about things like accruals or market to book?
ACCM, discretionary accruals, and MTB, market to book, they generally showed less consistent or significant impact compared to the others like sentiment, skewness, size, and turnover.
So when you put it all together, this new MCD-based model, the Neag outlier one,
Yeah.
it really did seem to perform better than the old ways.
Overall, yes. The variables it estimated generally showed higher statistical significance, and like we saw with ROA, they seemed more consistent with existing financial literature and intuition.
And they double-checked this.
They did. They ran a final robustness check using several different machine learning classification models.
Like what?
Decision tree, random forest, XGBoost, standard stuff in ML.
But
They all confirmed the model's predictive accuracy. And interestingly, the simple decision tree model actually achieved the best predictive score, the lowest error on this particular data set.
wow. Sometimes simpler is better, even in machine learning.
It can be, yeah. It shows the power of that approach for identifying these crash events.
Okay, so this deep dive has really highlighted, I think, two main things for me.
Go on.
First, the power of these advanced machine learning methods, like MCD, to build a more robust, adaptable way to measure crash risk.
Definitely a key takeaway.
And second, maybe the bigger surprise, is the critical role of that firm-specific investor sentiment. That positive link to crashes is, well, it's really something to think about.
It really is. This research gives us valuable insights. It strongly suggests that when sentiment for a company gets really high, managers might consciously or subconsciously hoard bad news.
Setting the stage for a later crash.
Potentially,
Yeah.
yes. And the ability of this MCD model to actually identify those negative anomalies and help predict future crashes is, I think, a really significant advancement.
This deep dive genuinely feels like a shortcut to getting informed on a pretty complex topic. It's just fascinating seeing how you combine these advanced analytics with, behavioral finance
Right, the human element.
and get such practical insights. It might really change how you think about risk.
And this study just opens up so many possibilities, right, for how we analyze markets. So a final thought for you, the listener. Given these insights, especially on manager behavior when sentiment is high, how might you start thinking differently about the information, the buzz you consume about companies?
What questions does it raise?
Exactly. What questions might this raise about the future of behavioral finance in actually predicting market movements? The study itself notes limitations, of course.
Like what?
Like they didn't include all possible behavioral variables, maybe CEO confidence matters or accounting conservatism, and exploring the timing, the lead lag effects between sentiment and crashes.
Lots more to dig into.
For sure. But it's a really exciting step forward in understanding and maybe anticipating these major market events.